In Solid Footing Chapter 5, we review the closing process. The closing process happens at the end of each period. As a result of the closing process, temporary accounts are closed out and revenues and expenses are moved into retained earnings. With revenues and expenses closed out, the accounts are reset to zero and we're ready to begin the next period. Let's look at an example. Assume we have an ending balance of $10,000 in sales revenue, $5,000 of wages expense, and $2,000 of rent expense. We begin the closing process by taking the credit in the sales revenue account and recording a debit. This zeroes out the account. Notice that the offset to the debit to sales revenue is a credit to retained earnings. We next close out the expense accounts. We take their ending balances and record credits. Notice that the credits are offset by a debit to retained earnings. We have effectively moved our revenues to a credit balance in retained earnings and our expenses a debit. Notice that the net change in retained earnings is a $3,000 credit. What is net income or loss for the period? Notice that it's the $3,000 I just referred to, the difference between the revenues and the expenses for the period. Retained earnings, notice, changes from beginning to end by the amount of net income for the period. If we had a net loss, the change in retained earnings would be a decrease. Having completed the closing entries, we're now ready to prepare a post-closing trial balance. The post-closing trial balance shows all account balances after closing entries. Assets, liabilities, and common stock will have the same balances that were on the pre-closing trial balance. Retained earnings will be updated. It will have a different balance than the pre-closing trial balance. Retained earnings will increase by the amount of net income for the period, or decreased if we had a net loss. All revenue and expense accounts will have a zero balance on the post-closing trial balance. This shows that we are ready to begin the next period, capturing new revenues and new expenses with a clean slate. Recall the illustration we have worked with previously in Solid Footing Chapters 3 and 4. Let's focus on the revenue and expense generating activities. Those are transactions 4, 5, and 6. 4, we acquired inventory at a cost of $16,000. In transaction 5, we sold 1/2 of that inventory for a sale price of $25,000 on account. The two journal entries were debit accounts receivable for the sale price and a credit to sales revenue for the sale price. Correspondingly, we recorded the expense of the sale, which was 1/2 of the $16,000 we had paid for the inventory, and we reduced our inventory asset account. Transaction 6, we recorded wage expense and the cash outflow to pay the wages. Adding these transactions to the prior 3, recall gives us this pre-closing trial balance. The closing process involves these temporary accounts. These permanent accounts will not be affected. We will use the pre-closing trial balance to prepare our income statement. We'll summarize our revenues, subtract out our cost of goods sold to report gross profit of 17, and then subtract out our operating expenses, the wages of 7, and report net income of 10. After preparing the income statement, we will then close these accounts. The income statement for the period would look something like this. We have the company's name, title of the financial statement, and in the case of the income statement, period of time. Our revenues, cost of goods sold, gross profit, our operating expenses, finally our net income. The closing entries we will prepare will be to reduce our sales revenue account to 0 and our expense accounts to 0. We will move these amounts as shown before, into the retained earnings account. 25 of revenues, 15 of expenses, an ending balance of 10 in retained earnings, and balances of 0 in our temporary revenue and expense accounts. The post-closing trial balance, notice we've zeroed out our temporary accounts and we've updated retained earnings for the increase our net income generated in the period from 0 to 10. From the post-closing trial balance, we're ready to prepare a balance sheet. We will summarize our assets, our liabilities, and our equity, stock, which is contributed capital, and our earned capital, 10 and 50. The balance sheet proves that our fundamental accounting equation holds. Our assets are equal to liabilities plus equity.